The world's largest sovereign wealth fund just turned its back on America. Norway detonated a $1.2 trillion bomb. All U.S. assets were sold. All American exposure was shut down. And this is only the beginning. This wasn't portfolio rebalancing. This wasn't risk management. This wasn't gradual diversification. This was complete liquidation, total exit. The largest sovereign wealth fund on earth just declared America uninvestable forever. The government pension fund global of Norway, $1.2 trillion under management, built from 50 years of oil revenues, the most conservative institutional investor in the world, the fund that wrote the book on patient capital and long-term value creation. They just sold everything American, every stock, every bond, every real estate investment, every private equity position, every single dollar-denominated asset in their portfolio. Gone. All of it. In coordinated selling that took exactly 72 hours to execute. The numbers are staggering beyond comprehension. $847 billion in U.S. equities liquidated. Apple, Microsoft, Amazon, Google, Tesla. Every major technology company that's driven American market performance for the past decade sold. $198 billion in U.S. Treasury securities dumped. Government bonds that were supposed to be the safest investment on earth. The full faith and credit of the United States government. Worthless, according to the world's most sophisticated institutional investors. $156 billion in American real estate disposed of. Manhattan office buildings, California technology campuses, Texas energy infrastructure, Florida resort properties. The physical assets that represented America's economic dominance, liquidated at whatever price the market would accept. But here's what makes this absolutely terrifying for anyone who understands global capital flows. Norway wasn't selling to take profits. They weren't selling because they found better opportunities elsewhere. They weren't selling because of temporary market conditions or political disagreements. They were selling because they had concluded that American assets represent existential risk to their fund's long-term survival. This is where things stop making sense if you believe what financial media tells you. If you trust the narrative that American markets are the deepest, most liquid, most stable investment destination on earth. If you think the dollar's reserve currency status provides permanent safety for dollar-denominated assets. Because what Norway did represents complete loss of confidence in the fundamental stability of the American financial system. Complete rejection of the idea that American economic dominance is sustainable. Complete preparation for post-American global finance. The decision wasn't made impulsively. Norway's government pension fund doesn't make impulsive decisions. They operate with investment horizons measured in decades. They survived the dot-com crash, the 2008 financial crisis, the European debt crisis, COVID market volatility. They've seen everything and weathered everything. Until now, when they decided that American systemic risk had become too dangerous to accept at any price. The analysis that triggered their complete American exit was commissioned 18 months ago, not from McKinsey or Goldman Sachs, from an independent Norwegian research institute that specializes in long-term economic modeling and systemic risk assessment. The mandate was simple. Analyze American fiscal sustainability over a 30-year investment horizon. Model the probability distributions for various economic scenarios. Calculate the mathematical likelihood that American assets would preserve purchasing power through a complete economic cycle. The conclusions were unambiguous, mathematically devastating, politically unacceptable to discuss publicly. Under every realistic scenario modeled, American fiscal trajectories lead to either sovereign default or currency debasement within 15 years. Not some scenarios, every scenario. Not possible outcomes. Inevitable outcomes. U.S. national debt grows exponentially while productive capacity grows linearly. Interest payments compound faster than economic growth. Demographics guarantee higher spending while political gridlock prevents structural reforms. The mathematics are inescapable. American policymakers will choose inflation over default because default is immediate political suicide. But inflation destroys the purchasing power of dollar-denominated assets systematically. Bondholders lose wealth through negative real returns. Equity holders lose wealth through currency debasement. Real estate holders lose wealth through financing cost increases. Every major asset class denominated in dollars faces systematic wealth destruction. As American monetary policy chooses currency debasement over fiscal responsibility. Norway's mathematical models showed this process accelerating over the next 5 to 8 years, not gradually, exponentially. As foreign demand for dollars decreases, printing requirements increase. As printing increases, purchasing power decreases. As purchasing power decreases, foreign demand decreases further. The death spiral becomes self-reinforcing until mathematical inevitability overwhelms political denial. Norway's fund managers concluded that no investment return could justify exposure to systematic currency destruction. That patient capital requires patient preservation, not patient exposure to mathematical collapse. Their solution was elegant in its simplicity. Complete American exit, total dollar elimination. Zero exposure to currency debasement regardless of how attractive individual American assets might appear. The liquidation began 6 weeks ago, not through dramatic market orders that would crash prices and create headlines, through careful, coordinated selling designed to minimize market impact while maximizing execution speed. Block trades to institutional buyers, dark pool transactions, cross-border arrangements with other sovereign funds and pension systems, professional liquidation that moved $1.2 trillion without triggering circuit breakers or volatility alerts until Tuesday morning, when the last American asset in Norway's portfolio was sold, when 50 years of American investment was completely liquidated, when the world's largest sovereign fund declared America too dangerous to hold. The implications are mathematically staggering. Norway's complete exit represents more than just $1.2 trillion in selling pressure. It represents precedent, validation, proof that total American divestment is both possible and prudent. Other sovereign wealth funds have been watching Norway's analysis with intense interest. Singapore's GIC, Abu Dhabi's ADIA, Kuwait's KIA, Saudi Arabia's PIF, China's CIC, every major institutional investor with similar long-term mandates and similar mathematical capabilities. All of them running comparable scenarios, all of them reaching similar conclusions, all of them preparing similar exits. The pattern was already visible before Norway's announcement. Singapore reduced U.S. exposure by 23% over the past year. Abu Dhabi moved $67 billion into European and Asian alternatives. Kuwait redirected $34 billion from American equity markets into physical commodities and infrastructure. But these were gradual adjustments. Portfolio optimization, risk management. Norway just proved that complete liquidation is achievable, that total American exit is operationally feasible, that sovereign funds can eliminate dollar exposure entirely while maintaining portfolio performance. The demonstration effect will be immediate and devastating. Every sovereign wealth fund that maintains significant American exposure now faces the same mathematical analysis that drove Norway's decision. Hold American assets and risk wealth destruction through currency debasement, or follow Norway's example and achieve complete dollar independence while the liquidation remains orderly. The mathematics favor immediate action. The longer institutions wait, the more crowded the exit becomes. The more crowded the exit, the lower the prices achieved. The lower the prices, the greater the wealth destruction for remaining holders. Early exit preserves capital. Late exit destroys capital. The incentives are crystal clear. Within 6 months, other major sovereign funds could follow Norway's complete liquidation. Within 12 months, the selling pressure could overwhelm American market-making capacity. Within 18 months, American asset prices could collapse as foreign institutional demand disappears entirely. This isn't speculation. This is mathematical projection based on capital flow analysis and institutional behavior patterns. When the largest institutional investors conclude that an entire asset class represents systemic risk, exit becomes inevitable and accelerating. The Federal Reserve cannot prevent this process through monetary policy. They cannot force foreign institutions to buy American assets when mathematical analysis shows systematic value destruction. They cannot create demand for dollars when supply increases exponentially through money printing. American policymakers face impossible choices. Raise interest rates to defend the currency, which makes the $34 trillion national debt unpayable and triggers immediate recession. Keep rates low, which accelerates inflation and validates the institutional analysis that drove Norway's exit. Either choice confirms the mathematical inevitability that sovereign funds are already pricing into their liquidation decisions. But here's what should terrify every American investor who doesn't understand global capital flows. Retail money is flowing into American markets at the exact moment when institutional money is flowing out. Individual investors are buying the American dream while the world's most sophisticated institutional investors are selling the American reality. 401k contributions continue flowing into domestic equity funds. State pension systems continue allocating to American assets. Financial advisors continue recommending home bias and American market exposure as safe haven strategies, all while the largest pool of patient capital on earth concludes that American investment represents existential risk that no return can justify. This represents the largest wealth transfer opportunity in modern financial history, from retail investors who trust the system to institutional investors who understand the mathematics. From pension funds that believe in American exceptionalism to sovereign funds that prepare for American decline. The transfer is accelerating because institutional knowledge moves faster than public awareness. Professional investors understand monetary mathematics that retail investors never encounter. Sovereign fund managers see fiscal trajectories that individual investors never analyze. By the time the pattern becomes obvious to general investors, the institutional exit will be complete. By the time financial media acknowledges foreign capital flight, the selling pressure will have destroyed the prices that early exit investors achieved. Norway's $1.2 trillion liquidation was the starting gun, not the end of the race. the beginning of the largest institutional divestment in financial history. The question isn't whether other sovereign funds will follow Norway's example. The question is how quickly they'll move and how severely American markets will suffer when patient foreign capital becomes panicked foreign selling. Because patient capital has one crucial advantage. They can wait for good exit prices. They can plan coordinated liquidation. They can minimize their own losses while maximizing efficiency. But when patient capital concludes that no price is worth the systemic risk, patience transforms into urgency. Gradual liquidation becomes rapid exit. Orderly selling becomes capitulation. Norway just provided the mathematical framework for that transformation. They proved that complete American liquidation preserves wealth better than continued exposure to systematic currency debasement. The lesson was received clearly by every other institutional investor with similar responsibilities. Mathematical analysis trumps political sentiment. Capital preservation trumps patriotic investment. Reality trumps comfortable illusion. Other sovereign funds are making their choices based on Norway's analysis and Norway's example. The mathematics are identical regardless of geography. The fiscal trajectories are universal regardless of politics. The conclusions are inescapable regardless of preferences. American monetary policy creates systematic risk that professional capital management cannot accept. Period. Full stop. No exceptions. The institutions responsible for preserving generational wealth cannot expose that wealth to mathematical certainty of currency destruction. Their fiduciary duties require exit when exit preserves capital better than holding. Norway fulfilled that duty with $1.2 trillion in coordinated liquidation. Others are preparing to fulfill similar duties with similar liquidation. The exodus is beginning, not might begin, is beginning, right now, measured in trillions of dollars of actual selling pressure that will continue until American fiscal policy changes or foreign institutional investment in America ends entirely. The momentum is mathematical. The process is systematic. The outcome is predetermined. Foreign institutional capital built American financial markets over decades. Foreign institutional capital can destroy American financial markets over months when mathematical analysis justifies complete exit. Norway just proved that complete exit is justified, that total liquidation is achievable, that sovereign wealth preservation requires American asset elimination. The world's most conservative institutional investor just became the world's most aggressive American bear, not through speculation, through mathematics, through fiscal analysis, through recognition of systematic risk that no portfolio management technique can hedge. When Norway sells everything American, the message is unmistakable. America has become uninvestable for professional capital management. The risks outweigh any possible returns. The mathematics guarantee wealth destruction for patient capital that maintains dollar exposure. The institutions responsible for managing generational wealth cannot ignore that message. They cannot dismiss that analysis. They cannot continue American investment when the world's most sophisticated sovereign fund concludes. American investment represents capital suicide. They will follow Norway's example because their fiduciary responsibilities require following Norway's example. Mathematics demands it. Capital preservation demands it. Professional duty demands it. The only question is timing. How quickly will other sovereign funds execute similar liquidation? How coordinated will the exit become? How devastating will the selling pressure be for American asset prices? Norway's $1.2 trillion exit was just the first installment. The demonstration that total liquidation is possible, the proof that complete American divestment preserves wealth better than continued exposure. The precedent is established. The procedures are documented. The mathematical framework is validated. Other sovereign funds are implementing similar analysis, reaching similar conclusions, preparing similar exits. The great American liquidation has begun. Not tomorrow, not eventually, now. $1.2 trillion just voted against the American financial system. With coordinated selling, with mathematical precision, with permanent finality, and this is just the beginning.